If you are watching this, you have likely already secured your own financial future. You have built your business, climbed the corporate ladder, and accumulated wealth. But now, the challenge shifts. It shifts from wealth creation to wealth transfer. The question is no longer, how do I make money? But, how do I ensure my children have a launchpad that puts them decades ahead of their peers? I am Kunal from EPK Capital. We specialize in building wealth for generations. Today, we are addressing a critical decision that every Indian parent faces, regardless of their net worth. The choice between the government-backed Sukanya Samriddhi Yojana and a dedicated, aggressive mutual fund portfolio. Now, if you search online, the advice is generic. It is written for the masses. They will tell you SSY is a must-have because it is safe. But at EPK Capital, we don't play by the rules of the masses. We play by the rules of wealth. Does a capped, locked-in government scheme actually serve a multi-crore portfolio? Or is it a psychological safety blanket that is costing you millions in opportunity cost? Let's look at the numbers. Let's dismantle the Sukanya Samriddhi Yojana first. I'm not saying it is a bad product. For a family earning 5 to 10 lakhs a year, earning 8.2% tax-free interest is phenomenal. It is a lifeline. But you are not the average investor. You are a high net worth individual. For you, this scheme has a structural problem. The cap. You can only invest 1.5 lakh rupees per year. Let's project this forward. If you maximize this contribution every single year for 15 years, and the government maintains this high interest rate, which is unlikely, you will end up with a maturity corpus of approximately 65 to 70 lakh rupees after 21 years. Now, pause and think. In the year 2045, what will 70 lakh rupees buy? If you are planning for your child to attend a local college in India, maybe it covers the tuition. But if you have aspirations for Ivy League education or a top-tier business school in London or Singapore, 70 lakhs in 2045 might barely cover one semester of tuition and living expenses. By relying on SSY, you are effectively capping your child's education fund. There's a second, silent killer in safe investments that wealthy investors understand better than anyone else. Inflation differential. We are told inflation is 6%. That is the CPI, the cost of potatoes and onions. But the cost of elite education inflates at a much faster rate. In the US and UK, education costs rise by about 5 to 6% in dollar terms. When you translate that to Indian rupees, adding currency depreciation, the effective inflation rate is close to 12%. If you are earning 8% in a fixed scheme and your goal is getting 12% more expensive every year, you are not building wealth. You are mathematically becoming poorer relative to your goal. This brings us to the NRI trap. Many of our clients at EPK Capital are global citizens. Their children may study abroad, work abroad, or the family may move to Dubai or Singapore. The Sukanya Samriddhi account is rigid. If your residency status changes, the account faces complications. In some interpretations, interest accrual stops for NRIs. Do you want your wealth tied to your physical location? So, what is the alternative? It is a structured, aggressive children's mutual fund portfolio. When we say children's funds, we mean a portfolio of high-quality equity funds tagged specifically for this goal. Here is the HNI advantage with mutual funds. Number 1. Unlimited capital deployment. You want to invest 50 lakhs today as a lump sum? You can. There is no government bureaucrat telling you how much you are allowed to save. Number 2. Ownership versus lending. In SSY, you are lending money to the government. In mutual funds, you are buying ownership in India's best companies. Over a 15-year period, diversified equity has historically delivered 12 to 15% returns. Let's go back to the math. If you invest that same 1.5 lakhs a year in equities at 14%, the difference over 21 years is massive. But more importantly, because you are not capped, you can build a corpus matching the actual future cost of a Harvard degree. Number 3. Liquidity. Life is unpredictable. Maybe your child is a prodigy and gets into college at age 16. SSY won't give you the money. Mutual funds will. Maybe you need the capital for a business emergency. Before we conclude, I want to highlight the biggest mistakes I see HNIs make. Mistake 1. The insurance mix-up. Do not buy child endowment plans or money-back policies. These products often have high commissions and returns that barely beat savings accounts. Mistake 2. Real estate for education. Real estate is illiquid. What if the market is down when she turns 18? What if you can't find a buyer? Education goals require liquid assets, not concrete blocks. Mistake 3. Ignoring tax efficiency. Yes, mutual funds have a 12.5% tax. But would you rather have 100% of a small return tax-free or 87.5% of a massive market-beating return? The tax is simply a fee you pay for superior growth. So, here is the verdict. If you are managing the portfolio of your driver or household staff, help them open a Sukanya Samriddhi account. It is the best thing for them. But for you, the strategy must be different. Maximize equity. While your child is young, take aggressive exposure. Global diversification. Allocate 20% to UAE's best funds. Review annually, not daily, not weekly. Once a year. At EPK Capital, we don't just manage money, we engineer legacies. If you want to structure a portfolio that balances tax efficiency and high growth, let's have a conversation. I am Kunal. Click the link below to schedule a private consultation with my team. Let's build something that lasts generations.